Hello and welcome to the Scan the Markets webinar with myself, David Madden. I'm a market analyst with Equity Capital in London, which of course is a part of the overall equity group, which includes FXPesa and Equity Nigeria and many other brands around the world. Now, before we actually get into the actual webinar itself, I'll just quickly show you the risk warning screens on the risk warning slides on screen here. And it essentially states anything that I cover in today's webinar and video is not to be construed as trading or investment advice. It's pretty my own thoughts and views and opinions. So moving on now, in relation to what's going on with the markets. Starting off here with the gold market, we can see the gold has seen a lot of volatility recently, largely to do with the violence and the terrible war that we're seeing in Ukraine. But as this story has evolved, so has the movement in gold. What's been going on recently? Why have we been seeing a downward move in gold recently? Well, there are several issues going on here. First and foremost, we've seen a rebound in the US dollar. We did see some weakness in the US dollar last week. Now we're seeing a firmer US dollar. Why is this important? Well, gold, like other commodities, is traded in US dollars. Whenever the US dollar becomes stronger, in turn, it becomes more expensive to purchase gold as it's listed in US dollars. So whenever there's often, not always, but there can be an inverse relationship between gold and the US dollar. The firmer dollar has put a downward pressure on gold. What's also going on, to a certain extent, the violence and the tragic wars that we're seeing in Ukraine, and as far as equity, as far as the financial markets are concerned, the longer the story continues to hang around and remain, the more and more traders become immune to it. So to a certain extent, the fear about the violence and the war in Ukraine, it has been fading. It was obviously quite high at this point here in the early week or the early days or the first week or 10 days of the conflict, when we saw gold spike to its highest level since August 2020. But since then, the continued headlines about the violence has almost having less and less of an impact on traders' mentality. We're seeing traders willing to go out there and take on more risk, i.e. go out and snap up assets that are deemed to be riskier, such as stocks, and in turn, turn their backs on gold. So another reason why we're seeing a downward move in gold. What's also on the also a factor as well. Yesterday, we heard from Jerome Powell, the head of the Federal Reserve, who essentially alluded to the possibility of actually even larger interest rate hikes from the Federal Reserve. The US Central Bank typically move interest rates by 0.25%, a quarter of 1%, or 25 basis points per move, typically. And it was alluded to that if and when we do have another interest rate hike, it might actually be larger than the typical allotment size. So with that, there is fear that we could be in for a spate of not only more interest rate hikes, but even larger interest rate hikes. And with that, we've seen additional downward pressure on the gold market. Now, you can see here from the chart, gold continues to hold, is trading below these three simple moving averages. We've seen a move lower in the RSI, which indicates the price bias is to the downside. While gold continues to hold below these three metrics, these three moving averages, it's likely the recent downward trend will continue. A move lower from here could see a target at 1895, a break below that could see find support at 1878. If we do see a snapback and a rebound in gold, where could we encounter resistance? We could encounter resistance at last week's high at 1949, and a break beyond that could take us up towards 1978. Looking here at euro dollar, there are some similarities between the two. We have seen some weakness in euro dollar in the past few days. Why is this? Well, as I mentioned already, there's been a rebound in the US dollar. A lot of the rally that we've seen in the euro dollar currency pair in the last week or two has been down to weakness in the US dollar. There's been other factors as well, but that's one of the major issues. Now that we've seen a rebound in the greenback, the US dollar, we've seen a bit of downward pressure on euro dollar. What's also going on in relation to central bank activity? Well, the European Central Bank, prior to the Russian invasion of Ukraine, they said they wouldn't rule out the possibility of hiking interest rates once this year. Now we're in a scenario whereby there's a war going on in Eastern Europe. Ukraine isn't in the European Union. Ukraine isn't in the Eurozone, but many Eurozone economies, such as Germany, are tied in, are connected to that conflict in the form of energy. So the euro came under a lot of pressure in kind of earlier days of the violence of the war. Hence why we saw a major drop in euro dollar in the first week of March. Since then, as I mentioned on the last chart, some of the fears around the war are beginning to fade, and in turn, we're seeing a bit of rebound. What's also going, this also ties into what are the European Central Bank going to do next? The ECB weren't particularly close to hiking interest rates before the conflict in Ukraine. And some people are questioning, are they going to be hiking interest rates at all this year? And in turn, these are sort of factors you consider what's going on with the European Central Bank. We can see here, as you know, in the short term, it's been in a very clear downward trend recently. We can see here that it's holding below these three simple moving averages. And when it continues to hold below these metrics, it's likely the near-term downtrend will continue. A move lower from here could see a target this area at 1.0949. And a break below that could see a target at 1.0899. Now, if we take a look at the RSI, we can see it's essentially trading in the middle of the range, which suggests there's no strong price bias in our direction. It's also worth noting, even though the short-term trend is clearly to the downside, the more medium-term trend has been one of an upward move. The market rebounding from the lows that we saw in early March. If we do see, if euro dollar can hold above this area here, this low in around, well, just in around kind of 110 or 109.49, if you can hold above that zone, it's possible that our medium-term upward trend will continue. Moving higher from here, we could look to retest last week's peak in at 1.1136, and a break above that could see a target of 1.1232. Looking here at the US 500, the S&P 500, we can see that it came under tremendous selling pressure in late February when Russia invaded Ukraine. We did see it under pressure throughout the first week or 10 days of March, but notice how the lows that we saw in early March didn't even actually break below the lows of late February. So that was almost an indication to say, although the selling pressure is not so bad as it was day one when the violence actually broke out. And with that, it's not a total shock that we have seen a couple of lows here which are higher. So it's not a total shock that we have seen a fairly strong rebound in the US 500 recently. We're now back up to levels last seen in kind of the early-ish February. So we're talking about 5-week highs being set on the US 500, which when you think about it, really speaks to how strong the market is. It's looking like the Federal Reserve have already hiked interest rates once this year. They're looking at doing several more interest rate hikes. Some of the hikes might become even larger, and there's still ongoing conflict in Ukraine, and yet the market is enjoying a rally like this. And we recently hit a 5-week high. While the market continues to hold above these three simple moving averages, it's likely the recent upward trend will continue. Moving higher from here, we could hit the target 45.28, and a break above that could see a target 45.92. If we do see any pullbacks in US 500, where we find support will potentially from this low here around 44.23, and this zone here around 43.73. So another one of the reasons why the US didn't fall as the US 500 didn't fall as much in March as it did at the very beginning of the conflict is because remember the US is geographically and economically separated from the conflict in Eastern Europe. And as I mentioned, we have heard a hawkish Fed recently, and it's almost says a lot about the strength of the market if it can rally in the face of hawkish language from central bankers. Sticking with the theme of stock markets, looking here at the UK 100, we can see it come under tremendous selling pressure in the first week of March as we were kind of in the early days or the first week of the conflict. But since then, we've enjoyed a fairly large rebound. Now, it is worth noting that as the conflict in Ukraine rumbled on, we did see a sharp move to the upside in commodity prices. Both oils and metals rose dramatically. And it's just worth pointing out that the UK 100, the FTSE 100, has a relatively large oil and gas and mining sector, has a relatively large exposure to oil and gas stocks and also mining stocks. So even though stock markets around the world were falling because of the war, metals were rising, oils were rising, oils were rising, and in turn, energy stocks and mining companies were doing well. So therefore, when the markets did set to turn around, the UK 100 was in quite a good position, and we've already seen here in the last few hours the UK 100 is at its highest level since early March. So we're talking, multi-week highs being set, which really kind of underlines how bullish the recent upward move has been. It's also a factor of the overall kind of fear around the war fading a little. While the UK 100 continues to hold above these three simple moving averages, it's likely the recent upward trend will continue. Moving higher from here, we could look to target this peak here, the peak of late February at 75.64, and a break above that could see a target at 76.32. Now, if we take a look at the RSI, we can see it's quite close to being in overbought territory. If it does move higher and it does move into overbought territory, that could be an early warning to say the upward move in the price has become overstretched, which could be a signal that a change in trend is in the offing. Now, if we do see a move to the downside in the UK 100, we could potentially find support from this area here around 73.85, and a break below that could find support from this zone here around 72.67. Coming on to the oil market, it obviously went on experienced huge volatility in the wake of the in the early days of the Russian invasion of Ukraine. We can see here around the kind of 7th, 8th, and 9th of March, it hit its highest level in 14 years. But since then, as I mentioned, some of the fear surrounding the conflict has faded a little. In turn, we've seen a sharp move to the downside in US oil. But it's worth noting that the lows that we set here last week are still comfortably above the lows that were set in mid to late-ish February on the run up to the conflict. So even though oil is well off its peak, it's still comfortably above the levels that we're seeing in mid to late February in advance of the Russian invasion. So the kind of much broader upward trend is still in effect. And we can look at the price action in the last 24, 48 hours. We've seen a higher high, a higher low, a higher high, a higher low. And what's also kind of going on at the moment, yesterday, the European Union announced it was considering imposing an embargo on Russian energy, Russian oil. And although there's some division over that, is it going to go ahead? Will it be only a partial ban? What is the outcome going to be? That is kind of still hanging over the oil market, and in turn, that's why even though we've dropped in the last few hours, we're still comfortably above the lows of last week. So once again, oil indicate a more medium-term trend is higher, and a much longer-term trend is higher for US oil. So while it continues to hold above these three simple moving averages, it's likely the recent upward trend will continue. Moving higher from here, we could look to target $116.53. A break beyond that could see a target the recent 14-year high of $126.47. Now, it's worth noting, if you take a look at the MACD indicator, there's been a clear decline in positive momentum. So although momentum is in positive territory, suggesting the bulls are in control, as it were, it seems as if they're kind of running out of steam, they're running out of energy. And if we do see a continuation of the short-term downward move in US oil, we could look to find support from this area here, just north of just south of $101 a barrel, in at $100.28. And if you drop below that, we could find support from this zone here around $97.36. Sticking with the theme of oil, we're now looking at the final chart of the day, dollar CAD yen, the Canadian dollar versus the Japanese yen. And the Canadian dollar is interesting because Canada has a relatively large oil and gas sector. In turn, whenever energy prices are strong, oil prices are high, that tends to boost the Canadian dollar. So hence this is part of the reason why we've seen such a sharp move to the upside in CADJPY. Also, what I've mentioned on previous charts, I've talked about how stock markets around the world, such as the UK 100, the FTSE 100, and the S&P 500, the US 500, have been rallying. With that, it's a case of, with that, what we've seen is we've seen a case of, with that, what we've seen is we've seen a case of stock traders clearly willing to take on more risk i.e. buy shares. So we've seen an upward move in the FTSE 100, we've seen an upward move in the S&P 500, and as a result, people have been turning their back on lower risk assets. I mentioned this was gold. Gold is deemed to be a lower risk asset, but then again, so is the Japanese yen. And so it's a kind of a double whammy. On one hand, the strong and bullish oil market and the fears of an EU oil embargo is pushing up the price of oil. At the same time, traders are selling the Japanese yen, hence why we've seen CAD yen hit a multi-year high. I believe it was a 7-year high that was hit on the currency pair in question. If you take a look at what's going on in terms of the price action, where could we actually go from here in terms of next levels to watch out for? We could be looking at heading up towards 97, and then beyond that, the next big psychological number to look out for will be 100. If you do see any kind of pullbacks, because let's face it, looking at the RSI here, we can see there's a sharp, we're very clearly in overbought territory on the RSI. So this could be an early warning that the upward move in price is very much overstretched. If you do see a pullback, where can we pull back to? Well, perhaps you could pull back to this low here around 94.35, and a break below that could see a target this zone here around 93.46. Just getting some questions here. The DAX. I'm just looking at the question here. There's a question here about how does higher interest affect the USD? Is it weak or is it strengthens? Broadly speaking, if a central bank, whichever central bank it is, for example, the Federal Reserve, the Central Bank of the US, if they hike their interest rates, that typically pushes up the domestic currency. Why? Well, because if the central bank in the country is hiking interest rates, then that's likely to lead to higher interest rates in all the kind of commercial banks within the country. So therefore, people around the world would say, oh, look, the Federal Reserve, they've increased their interest rates. And it's also looking likely that they're going to have more interest rate hikes later this year. If I have any spare cash in deposit sitting somewhere in any one of my bank accounts around the world, I may as well have it sitting in a US bank account, because they've already hiked interest rates, which is so therefore they're probably offering a better interest rate to return than having your cash in, say, for example, the Eurozone central bank, but also the possibility of even further interest rate hikes. Often what happens is, when it looks as if a central bank is going to hike interest rates, the currency market, the domestic currency already moves. And then often the case is, whenever the actual hike does happen, the currency either kind of stands still or often even falls, because a lot of the move was already factored in. So I hope that answered that question. In relation to other markets, so take a look now at the DE30, the DAX. The prices that I have on screen may not be the most up to date. Excuse me. So just bear with me. I talked about earlier on in this update about how the UK 100 and the S&P 500 are moving higher. In fact, we've seen multi-week highs on both markets. We're seeing something similar with the DE30. It's not quite as high, but we're not too far away from retesting last week's peak. And last week's peak was about a 2-week high, or a kind of 2.5-week high. So we've seen a steady rebound in the DE30. If you take a look at the MACD indicator, it's in negative territory, but negative momentum is declining. And as it's declining, it suggests the bears are losing influence. So if we continue to hold above these 3 simple moving averages on the DE30, it's likely the recent upward trend will continue. A rally from here could see a target this area of 14,676, and a break beyond that could see a target of 14,920. If we do see a bit of a move to the downside, where can we find support? Well, I'd be looking towards this moving average here, the 100-period moving average. It essentially acted as resistance here, and on a couple of occasions it acted as both resistance and support. And what I often find is, if a metric such as a moving average or a trend line or a support and resistance zone, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. So that moving average comes into play at around 14,092. just, I should have pointed out earlier on, I'm actually looking at 4-hour charts. So it's a 100 period moving average on a 4-hour chart. And if you do break below that, we could be looking heading back down toward this low here in around 13,576. I have a question here about the NASDAQ 100. So the NASDAQ 100, some of the prices are a little out of date because I haven't looked at that market in a bit. 13.95, 77. $188. So the NASDAQ 100, like other stock markets, be it the DAX, be it the UK 100, or be it the S&P 500, is rallying as well. It's enjoying a fairly strong rally at the moment. We managed to kind of eke out its highest level basically since mid-February. So we're now back to levels prior to the Russian invasion of Ukraine. So so really kind of speaks to how strong the market is if it's actually at a level whereby it's kind of recouped all of the ground lost that was lost in the wake of the Russian invasion of Ukraine. Just gonna, if you bear with me one moment, I'm just looking at various different levels, areas of potential support. 981. So we can see here it's in a strong upward trend. It's in a multi-week high, which really underlines how bullish the market is. If you take a look at the simple moving averages, we're well above all three of the simple moving averages. I haven't gotten close to kind of retesting one in a while. That really kind of speaks to how kind of strong the market is. If it's kind of even pulling away from the moving averages, if you continue to move higher from here, we could be looking at targeting this peak here around 14,675. And a break beyond that could target this zone here around 15,077. What I will say is this, is that there's a relatively long wick, there's an ever so slightly longish wick on this candle here, this skinny line that you see proceeding out at the very top. A longish wick on a candle can denote indecision. Not to say that the market is guaranteed to turn around or trade sideways or whatever. It just might be a case of it's possible the preceding upward trend continues just at a lower pace, or we might see a bit of a pullback, the market pauses and then moves higher again, or we could see the market pull back a few hundred points. But the fact that we have a longish wick tells me, okay, we could see a bit of a pullback. If we do see a pullback, where can we find support? Well, I'll be looking down towards 14,188, and a break below that could see us back down towards 13,981. And again, the last chart of the day I've been looking at is I got a person here asking for GBPJPY. So I already talked about the CAD yen and how the Canadian dollar was doing very well against the Japanese yen. That's largely down to the fact that we've had a strong oil market. We've had an interest rate hike for the Bank of Canada. We've had rate hikes from the Bank of England. So I suspect, even before I look at the chart, I wouldn't be surprised if you see GBPJPY in a strong upward trend. GBP, I need to look for where the currency pair is actually listed. It's been a while since I've looked at sterling yen, but the price action we're seeing here on sterling yen isn't a million miles away from the price action we're seeing on other currency pairs. So we're talking back to levels last seen several years ago on sterling yen, which really speaks to how bullish the market is. Back up to levels last seen in 2016. So we're talking going on a 5-6-year high in sterling yen, which really says how bullish the market is. Excuse me. Excuse me. So we've had a kind of 5-6-year high in sterling yen. To me, that's a kind of really kind of flashing sign to say how bullish the market is. If you look at the market indicator, the steady increase in positive momentum. So not only are the bulls in control, they seem to be gaining influence. So they're becoming more and more powerful, driving the market higher. We're well above all three of these simple moving averages. If we continue to hold above these three simple moving averages, it's likely to get the bullish trend will continue moving higher from here. I'd expect us to get, I wouldn't be surprised if you get back above 160 and then at the target 162 and then a more medium term target down the line of 165. I can see here on the RSI that we're well into overbought territory. So it's quite possible that this upward move has become very much overstretched. If we do see a move, so that could be a sign we see a bit of profit taking or perhaps some shorter step into the fold in the near term. If we do see a move lower in sterling yen, where could we go? Well, I'll be looking back down towards this peak here around kind of 158, because with this peak, this area resistance previously is kind of a bit of a consolidation zone, a very small one. It's almost like, a pit stop as the market was moving higher. So I'll be looking back towards kind of, 158.80 and then 158.00. These are the kind of levels I've been looking out for. If you have quite a large pullback in GBPJPY, I'll be looking back down toward this moving average here. You can see how the 20-period moving average acted nicely as support here only about a week or two ago. And once again, if a moving average has been of importance in the past, it makes it more likely to be important in the future. It sort of acted as support here in early March. It acted as resistance here in late February, whenever the war was in its very early days. And that moving average comes into play in around this level here, in around kind of 157.60, thereabouts. So on that note now, I do thank you for your questions and for your interest. I'll be looking to wrap things up there, seeing as we've actually been going on for a little longer than I thought. But I do appreciate you joining me. My colleague Mohammed Shanti will be back soon. He just basically was offered today. And I'm sure he will see you soon, and I'm sure I will see you soon as well. And we are looking to kind of, this is a regular occurrence, these webinars. So feel free to come to as many as you want. And the more participation we have, the more interaction we have with yourselves, the more enjoyment we get out of it, and then the overall experience is better for everyone. So I'll be signing off now. So it's goodbye from me. Have a good evening and have a good trading week.
Okay.